Greetings and salutations. Today we're going to look at the company Malibu Boats, headquartered in the United States and traded on the NASDAQ Stock Exchange under the ticker MBUU. Please stay tuned for the important disclosure information at the conclusion of this video. Malibu Boats is an American designer and manufacturer of recreational boats. It was founded in 1982 and has been public since 2014, but the business model of the company is to engineer, produce, and market recreational powerboats. The engineering team includes 123 professionals. The company owns and operates 8 manufacturing facilities, and it sells the product through a dealer's network consisting of 325 locations globally. About 95% of the sales are in the United States and 5% overseas, mostly in Australia. The company's business model also includes acquisitions of similar businesses. The company operates in 3 segments. The first is sport powerboats, including Malibu and more affordable access brands. The second category is saltwater fishing boats, including Pursuit and other brands. The final category is premium luxury class cobalt boats. Let's look at the historical performance of the company. Revenue reached $808 million in 2025, showing a 14% compound annual growth rate since 2012. After 40% revenue drop in 2024, it stabilized in 2025. In 2025, the sport boat segment contributed 39% of the revenue. Fishing and luxury premium segments were 35% and 27% of the sales, respectively. Incredibly high growth of revenue can be traced to acquisitions of fishing and premium brands. The company acquired fishing brands in 2019 and 2020. Premium brand was acquired in 2018. Over the last 10 years, the company successfully grew the number of boats sold and the revenue per boat, significantly outpacing inflation. With the data provided by the National Marine Manufacturers Association, we can compare company performance against the U.S. market for the sport boat segment. Since 2014, the company successfully matched the U.S. market by revenue, retaining about 40% of the market share. Since then, the company specialized further in selling higher-priced boats. Let's look at the expenses. The cost of goods sold is hovering around 75% of the revenue, making the gross margin at 25%. Gross margin dropped to 18% in the past 2 years and is expected to continue to be depressed at about 20%. Sales and marketing expenses increased to $23 million in 2025, or about 16% of the gross profit. Historically, administrative expenses hovered around 30% of gross profit, but elevated to 64% in 2025. Taxes averaged 6% of gross profit. Equipment and capital expenses accounted for about 20% of the gross profit. Historically, free investable cash flow was relatively stable at about 36 to 39% of gross profit, but dropped to 20% in 2025. How did the company allocate its capital? Since 2012, almost 2/3 of the accumulated free investable cash flow was invested in acquisitions. 22% of the free investable cash flow was spent on inventory increase. The inventory levels are elevated at 17.6% of revenue, with the historical average at 7.5%. The company successfully issued and repaid debt in the past. Current debt is at $18 million. And successfully issued and repurchased shares. The remaining free investable cash flow was retained as cash and other assets. Leadership, including the CEO, was almost entirely renewed in the past few years. Together, individual insiders own just 1% of the company. The liquidation value per share is estimated at $13.20. Now let's estimate the intrinsic value of the company. For 2024, the company experienced a 40% revenue drop. This is mostly due to 2 major reasons. One of them is the oversupply of dealers' network inventories. The other reason is the weakness of the consumer for discretionary spending, given elevated interest rates. Overall, the industry of sport boats is highly cyclical. Therefore, we will evaluate 2 major scenarios. First scenario, imitating the dot-com bubble or a soft landing, we project a market recovery at 6.5% compound annual growth. Second scenario, imitating the financial crisis of 2008, we project a further revenue drop by 25% in the first year, a 0% growth in the second year, and a subsequent recovery of 12% per year after. Let's look at the soft landing scenario. We will assume the reduction of inventory to the historical 10%, thereby lower production expenses. We will also assume sales and marketing expenses will continue at 11% of gross profit. Administrative expenses are projected to be fixed at $92 million. Debt interest continues at current levels till the debt is paid off in 2032. Tax to return to 6% of gross profit. Equipment expenses to remain stable at $40 million per year. The remainder of free cash flow the company will return in the form of stock buybacks. Given all these assumptions, by 2032, with the historical price to free cash flow ratios of 10, 14, and 18, and the discount rate of 7.5%, we can estimate the intrinsic value at $43.7, $61.2, and $78.8 respectively. Now, let's consider scenario 2. A catastrophic collapse of revenues by 25% in the next year, no growth in the year after, and a subsequent recovery at 12% per year, similar to how it happened in 2008. With these new assumptions, by 2035, with the historical price to free cash flow ratios of 10, 14, and 18, and the discount rate of 7.5%, we can estimate the intrinsic value at $40.4, $56.5, and $72.7 respectively. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.